welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in. And if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to a new episode of the Capital Mind podcast. In today's episode, Deepak talks about the dramatic growth in options volumes on the Indian stock market and what this means for investors like you and us. We discuss the history of options, how large the growth has been, factors contributing to this growth, what ZDTE or zero day to expiration options are, ways people lose money through options, risks you need to watch out for, and who is best positioned to use options well and how they should do it. So do listen in to see if options make sense for you and whether you need to care about the options trading volumes in our market. Hi Deepak. So if I get this right, options trading is taking over the stock market, and the amount of trades that used to happen 15 years ago in a year are now happening in a day by some metric. And this is a big deal. I'm just very puzzled by this whole thing because I often viewed options as weapons of mass destruction if you didn't know what you were doing. But no one seems to be too hurt by this so far. So we wanted to ask you about this. And let's start. Can you tell us a bit about the history of options and explain, in India of course, and explain how big this growth really has been and why that might be the case?
I think this is actually the thought of market players today, saying everything's happening in the options universe. But what are options? I think, the traditional definition is options are the right, but not the obligation to buy or sell something at a certain price. Now, that price is called the strike price. So I can say the Nifty is at 19,800 today. Can I get the right to buy the Nifty at 20,000, which is the strike price? If it goes to 21,000, so I make the difference between 20,000 and 21,000, which is 1,000 rupees. But because it's only 19,800 right now and I only become profitable above 20,000, you might charge me a premium of say 100 rupees. So in a way, I've invested 100 rupees, and if the Nifty goes up to 21,000, I make 1,000 rupees. This is 10x my return, etc., etc. This is how the thought process goes. But think about these because I think we'll go through these technical terms in the middle. There's a strike price, there's an expiry date. Every option expires at a certain time. So that expiry is usually a month away, can be 2 months away, can be 6 months away, can be 3 years away in the traded options in India. So given this, what is actually and why is this kind of existing? These are derivative products, right? So we've had derivative products in the past called Badla. The Badla, the idea was don't pay me right now, pay me later. Now, why would I do this in some meaningful way? Is if I wanted to lock in the price of what I wanted to sell today for a later date. That is the idea. I started off with, say, farm commodities where I grow a wheat, but I'm growing it right now. I know it's going to come. It's going to have a yield of, say, 100 tons. I want to just sell it right now so that I know the exact selling price today itself. It is possible that later the price of wheat is higher than today, in which case I lose money because I could have sold it higher at a later price, at a later date. Or if it goes down, I win because I sold it at today's price and tomorrow's price is lower. So therefore I make it happen. Options are just another way, another layer to say, I will only sell it to you if it is above a certain price, or I will only buy it from you if it's above a certain price. This, derivative transaction earlier used to be in something called Badla in the stock market, where you just simply refuse to pay right now. And you said, listen, I want to pay you in the next cycle. And then there would be something called a Badla fee, Vyaj Badla. What is the fee for you to do this? And every 15 days, this Vyaj Badla would be a certain rate, and that would be 2% or 1% or 0.5% or something like that. Now, actually, when Badla moved into the derivatives market, you got futures instead of Badla. And options started I think it started way early, but then you saw some nifty options started taking place in 2004, I think. And then 2006 is when stock markets really started to, options started to really take place and really kind of grow. At this point, when 2004, 2006, I remember this because I was trying to trade options at that time. There was very little understanding from the retail universe. A lot of people would simply look at it and say, oh, this is another way to kind of participate in derivatives. A lot more action was happening in the futures market. So you saw a lot of these proprietary companies and the PMSs of that time kind of build options positions just to kind of hedge or do something. Even in 2007 and 2008, I remember players trying to sell options or buy options based on a few quantitative factors, but these guys there was like maybe 1 out of 100,000 that were actually doing this. Forward to today, in 2009, 2010, the total annual traded contracts was 34 crores. That 34 crore contracts, and that time each contract was 2 lakhs of notional size. That time it was 50 Nifty, it became 75 Nifty, came back to 50, lots of things. So you had about 34 crore contracts traded in the whole year. So 3 crore a month, less than 3 crore a month. Today, it is 4,544 crore contracts as of yesterday, which is October 25th.
Well, that's 35 crores a day.
35 crores a day. Because it's only the first 6 months, right? So it's 35 crores a day. So you're seeing 1 day's trade equal to the whole year's trade of 2009-10. And 2009-10, you'd already gotten fairly popular. Guess where it was in 2006? It was like 8 crore contracts for the whole year or something like that. So we're actually, or 4 crore, or 2 crore contracts for the whole year. 2 crore contracts for the whole year versus 4,544 crore contracts for just the first 6 months. Today, everybody's playing it. Retail is one of the largest players in the option chain, which retail, I mean retail and HNI. People like you and me who might have accounts and all that stuff.
I'm not allowed to trade. Neither are you, by the way.
Neither am I. So people who have accounts like us but not like us are allowed to trade. So interestingly, proprietary traders, brokers who have their own accounts and all that stuff, they are the second largest, I think, pool. Maybe that has shifted in the last 2 months to them becoming the largest, but they are one of the larger players. And the number of players in the FII space, the foreign institutional investor space, are relatively much smaller. FIIs, corporates and Indian institutions are very, very small. Now, that's because of multiple rules. One of the rules is that I'll come to that, I think,
so
the later point.
I do have a question. You've given us a sense of the magnitude of the increase, what happened in a year is happening in a day. You've also told us what it used to be historically in this Badla format and so on. But how do you explain this 260x increase in options trading over a year? What are the factors that have led to this increase? Could you talk through us that as well?
Yes, I think this is actually quite important because I've seen this market grow from when it was nothing to when it is now. So in a sense, I got some of an idea, a little bit of an idea. One of the most complex things that was there earlier was that STT was applicable on options, and STT was very, very large. They would apply it as a percentage of the notional value of the option. Now, can you think about it from a Nifty perspective? Nifty is about 19,800 or 19,000 today. And then if you bought a single contract was 50 times Nifty. So that means 19,000 into 50, roughly 9.5 lakhs. This is the notional value. But what I pay is probably just 20 rupees per contract, per Nifty, which is into 50 is the Nifty size. 20 into 50 is 1,000 rupees. So my premium amount is 1,000 rupees, but my notional amount is 9.5 lakhs.
Almost 10 lakhs. So
now, if I charge you STT on the 9.5 lakhs, which is of even 0.01%, I would be charging you 100 rupees. The STT would be 1/10 of the amount of premium I'm paying. So if I'm paying 1,000 rupees, I have to pay 100 rupees in STT on the way in, or rather on the way out. So effectively, I'd have to make a 10% profit on my investment just to break even with STT. This sounds extreme. So over time, STT moved away from being charged on the notional amount of turnover to being charged on the premium itself. So it was 0.01% or 0.1% or whatever the number is of the premium you've received. That means if you've paid a premium of 1,000 rupees, it's 0.1% of that, which is 1 rupee or something like that. So now your profitability changes because I don't have to earn 100 rupees. I don't have to earn 10% profits. I can earn just a 1 rupee profit and I'm profitable. This is basically now you can take more contracts by doing something like this. Now, the other important thing is that when you reduce the STT for options, but the futures STT still continues to be on the volume. So I'll give you an example again of the Nifty. I think the Nifty's future STT on the that is Securities Transaction Tax on the futures market is 0.1% or roughly 0.01%. It's 0.017%. Take whatever it is, which is roughly 0.01% is 1,700 rupees per crore. So it is 170 rupees per Nifty contract, which is about 10 lakhs. That means per Nifty it is 3 rupees. So that means if the Nifty, you have to move 3 rupees just to make up the STT in that sense. We all know that because of the theory, and you study this in MBA and all that stuff, is that you can build a futures position by a synthetic options position. So that means if I want to get a payoff that says a futures payoff is if the stock goes up 10 rupees, I make 10 rupees. If the stock goes down 10 rupees, I lose 10 rupees. That's the concept of a future. It's on the notional value. So if I want to build the same payoff using options, I would say, listen, today the Nifty is at 19,000. Let me buy a 19,000 call and sell a 19,000 put. When I buy an option, I have the right but not the obligation to buy. If I sell an option, I have the obligation to sell if the stock is below that price. So the combination of these two means that if it goes up, I can buy and realize a profit. If it goes down, I will have to sell and make a loss. So in the sense, I will make a loss if the Nifty were to fall. So I could buy a call and sell at the put at the same price. Now, if I sold a call and sold a put at the same price, the premium added up might be of the order of maybe 300 rupees. Now take the 0.01% of 300. The STT for 300 will be less than 3 rupees. So I'm comparing a 170 rupee STT on the futures with 3 rupees on the synthetic option position that gives the exact same payoff as the exact same margining or roughly the same margining and so on. So people, because they can do that, the STT is substantially lower. So people who were using futures earlier now have realized that the STT differential is so large that the options can be used. So they have moved there. That's number one. I think the second one is that you've suddenly had a lot more interest in synthetic arbitrage positions with indexes. Now, what does that mean? I mean, let us take the Nifty itself. It has 50 stocks. Each of the 50 stocks has futures and options on it. Now, typically the answer to saying what is the Nifty is it's the sum of the weighted prices of the individual stocks in the Nifty. So you can say that Sun Pharma has a weight of 0.3%, but Reliance has a weight of 8%. So if Reliance were to move 1%, it hits the index more than if Sun Pharma moved 1%. So effectively you construct the index by saying I'll take the weights of each stock, I'll take the percentage gain in each of them or the loss in each of them, apply the weight to that, and that's the Nifty change for the day. However, the synthetic Nifty would be I buy a Nifty index future and I buy the futures of all the individual stocks that are existing in the Nifty. I would then, the prices of the individual futures of each stock may differ very rapidly from the Nifty itself. So you want to bridge the gap. You might actually build an algorithm that says, I will arbitrage the two out, the Nifty index futures and the individual stock futures of the Nifty. When you do that, you will realize again that gain could be high enough for it to be, because there's a no risk position.
It could be worth your while and worth your capital.
And that since it becomes more popular, it can be done by computers, that's one part. And of course,
Deepak, I have to say, look, these two answers right now are a bit boring, right? STT has come down and this, I've read the articles. Come on, that's not the reason why options trading has gone up 300x, right?
Yes, of course. I think, we'll come to that because I think there's also the itch factor, but the itch factor has always remained. But let me ask you, let me put it another way. The reason why it has become popular is also because these costs and the arbitrage trades, for instance, have lowered the cost of options. And that itself contributes to one fact. Earlier, Nifty options used to be very expensive. That means you had to pay 150 rupees or 200 rupees for a relatively close buy strike price. Today, you can buy an option for 20 rupees. And I'll come to why that is interesting. It's also because these arbitrages are played. Now, for a speculative player, this suddenly becomes very interesting because, like you said, the interesting part is not that people are arbitraging or creating hedges or buy low RSTT. The point is, if for a hundred rupees I can make 1,000 rupees, this excites people to no end, saying I can make 10x my money in a day. The speculative interest is quite high by nature. So that's also added to that fact. But I think all these factors contributing in making that market exciting. The third thing is also that technology has come into play. And I'm talking about just not technologies from a perspective of, just faster execution and stuff like that. But also that options come with all sorts of, magical numbers, because optionality is a thing, right? So it's well studied in theoretical constructs. So there's a lot of Greek numbers called thetas and gammas and all that stuff. So people will talk to you about delta neutral strategies and gamma scalping strategies, and all these things happen only in options world. You don't do that in the futures world. So the way to do this would be to buy one option but sell another one at a different strike price of the same underlying stock, which is like the Nifty or something like that. Now, if you did that, where would your position be at any given point in time? Can I visualize, if the Nifty moved 5%, how is my buy one option, sell the other option? How will it react in price if the Nifty moved up 5%? You can now model this online using graphical visual tools. And by the way, we built one ourselves.
Yeah, I think our colleague Vashish built it to teach himself how to code stratoptions.com back in the day.
Correct. And then, all sorts of complications. And now, of course, a bunch of other people have visual strategies. There used to be a tool called Options Oracle written in a language called, it's written in C#, I think. And which also use visual interfaces to determine how a strategy would work, an option strategy would work. So you could actually design like, I'm going to short this option, this call option. I'm going to short this put option. And I'm going to buy another call option, buy another put option. Tell me how my prices will change today, tomorrow, and so on. So technologies allow you to do all these things. And once you decide this is what I want to do, you can go in now and take a position directly. Now, some of these tools even allow you to automatically take positions by clicking a button and then going to your brokerage and predefine your trades are already in there. You click a button and then you're done. This is great. I think this is layer 3, the technology part. The layer 4 is very interesting, where I think your point comes in. The biggest thing became the brokerage. Now, I remember talking to Nitin in 2006, and he was at that time running a small brokerage called Reliance Money or something. I was a customer. So Reliance Money did something extraordinary according to Reliance Money, of course, which said that they would charge you 20 rupees per lot as brokerage. Everybody else charged a percentage of the notional as brokerage. Now, the percentage of the notional could mean your brokerage becomes 150 rupees per contract. A lot is a contract, which is too much. So what they decided was that, listen, let's not look at, because number of shares of Nifty are 50. If you multiply 19,000, which is the current Nifty value, by 50, you get 9.5 lakhs. Whereas a Vedanta maybe contract size may be only 4 lakhs. Somebody else, the contract size may be 7 lakhs. In some cases, it's 15 lakhs. So your percentage of notional becomes too high at some level for people to deal with. So what Reliance Money did was, we'll do it per contract. We'll charge you 20 rupees per contract. Nitin had a better idea at the time. And he said, instead of charging you per contract, let me charge people per order. So you want to do 10 contracts, it's the same cost if you want to do one contract. So it was 20 rupees per order, or which essentially changed the game for retail, because now they could do a 10 lot contract and get profitable with a brokerage cost of only 20 rupees each way, which is 40 rupees.
So this was one of Nitin's stroke of genius, right? I mean,
and or to be fair, of course, the foreign brokerages have already started something like this in the US and all that stuff. But I think this was unheard of in India at the time. And 2009 or 2008, when they started off with this model. It became extremely popular very quickly. And strangely, the other brokers copied it for the first 5 or 6 years. So
have they finally started?
They have. Okay. Now almost everybody offers a fixed per contract.
Only took them about 10 years.
Yeah, unfortunately, until Zerodha became the biggest player in the world.
And they were like, this is actually real. We can copy it.
Let's copy it now. Yeah. So interestingly, at the same time, because of this lower cost, retail became very interested in selling options. Now, why do they do that? Because institutions in India can't sell. Now, there's a weird problem, right? So technically you would expect the money
They can't sell
institutions.
because of regulation, right?
The regulations, yeah. The regulations don't allow them to sell options naked. They don't allow them to take naked position. Naked being, if I don't have the underlying shares, I can't sell the options and so on. So because institutions can't really participate, you only got hedge funds, prop players, foreign hedge funds, Indian prop players, and Indian retail that were interested in selling options. This is great because options, and even SEBI's put out this statistic, but it's also known worldwide that people who buy options largely tend to lose money. If you buy an option worth 100 rupees and it expires out of the money. When I say that, it means that if I bought a 20,000 wala option and the Nifty is at 19,800, but Nifty only goes to 19,900 by the time my expiry date approaches, I don't make any money because it hasn't crossed my strike price, right? So you essentially, most options just expire worthless. So if 99% of people who buy options lose money, therefore the people who sell options must be making money. So if you can make money 99% of the time, it's obviously attractive for someone to write money. In fact, in India, it's a very different scale. To buy an option, you just need the amount of premium. Premium is 50 rupees, lot size is 50, so 50 to 52,500. That's all you need to put in. If I want to sell the option, I will get the 50 rupees. I will earn the 50 rupees as a premium, but I need to put down at least 50,000 rupees as margin, as option margin, to be able to deal with this trade. So it's a very what do I say? It's not
Lopsided.
It's lopsided. Yes, in the sense that sellers need to be heavier in their cash positions
Fair,
and
but
the margins.
if the probabilities are 99% of the time I'll make money, you're inadvertently making this conversation very enticing. I mean,
It is in the problem really is when you lose money, you lose large amounts of money, and when you make money, you make pennies. So or pesos.
so this is that pesas in front of the steamroller.
Steamroller, yeah.
Okay.
The steamroller moves, they run you over. But we'll come to that because that's a complex reason why selling options is always not, it's not always going to make you money. But when there are enough sellers and you have enough sellers who can put in 1 or 2 lakhs now, if there are enough sellers, there are enough buyers as well. So you buy when the seller is available, there's enough liquidity, so you just go in and start buying. This is awesome for the retail speculator who just wants to come in and play the game. Number 5, and I think this is the most important reason, I'm going to save this for the last, is the weekly options and effectively now the 0 days to expiry or ZDTE options, 0 DTE options. This changed the game. Now, what has happened is that options expire worthless. We know this, right? So as an option gets further and further away from its maturity date, that means its expiry date is 2 months away, I have 2 months of volatility in the middle to last that. So I pay something called time value. That time value is accounting for the fact that the stock can be volatile. The seller says, boss, you have 2 months left, anything can happen, so I'm going to demand a very high premium. This high premium has 2 layers to it. One is something called the time value, and one is something which is the effective interest rates in the market. If the interest rate in the market is 10%, then you'll at least charge that 10% of the undeployed capital because you're planning to buy it from me in the future. I will assume there's a cost of carry for those 2 months. There's that interest rate. And secondly, there is a time volatility. That means I expect that volatility can be very high. So if a stock is going to move 1% a day on a 20-day period, it can move plus 1% a day will be plus 21 or 22% and minus 22%. So you can actually potentially see the stock go all the way to extremes. And if you put that bell curve around it, you will say, oh, instead of going 1.2%, it may actually end up being as much as 8% volatile on the upside and 8% volatile on the downside. So I'm going to charge you a high premium for the time value that is remaining in the remaining period to expiry. In a weekly option, the maximum time you can have is a week. That means it's going to expire next week. Second, the number of days that you have left has a huge determination. So if I have time value for 5 days is 50 rupees. If 1 day passes, the time value falls to 40 rupees. Another day passes, it should fall to 30 rupees. It doesn't actually fall. It's not symmetric. But let me just give you that for an example's sake. So essentially, if I sold the option today, by next day, if the market hasn't moved too much, I make 10 rupees free of cost. And then if it doesn't move another day, I make another 10 rupees free of cost. What if I were only to play in the 2-day options, which means from right now to tomorrow? So I could sell a Nifty option today and you charge me 10 rupees and it's way out of the money. It's like 5% out of the money. The Nifty has to move 5% for me to lose money. And so I write this option and you pay a premium of say 6 rupees per share. If the Nifty doesn't move 5% in one day, I make the 6 rupees. All of it is mine. And that 6 rupees can be huge because it can add up, or I can do multiple contracts and I have to have my money locked in only for 1 day or 2 days.
Surely the Nifty won't move 6% in a day most days.
And here's the interesting part. You could do this from the morning to the evening. I could start in the morning as 9:15 and say, the Nifty is not going to move 3% today. So guess what? I will write the Nifty option that's 3% away on each side. The call option 3% up and the put option 3% down. And you know what? Let me rake it in. Because the Nifty is not going to move 3% in a day. Once in a while, it will move 3% and you're dead. And
we'll come to that.
How
dead am I?
Is an interesting question. But this is where I think the popularity of the options becomes very interesting, because you have very little time value to play with. So it's all speculation. It's like, oh, you know what? It's only 6 rupees. Let me buy it. And then if you get lucky, that 6 rupees becomes 60. I'll give you an example. Yesterday, there was Google's results. Google's results came in, the Google fell 9%. A person who had bought the Nifty option with Google options in the US, say the weekly options is maturing this Friday, which is in 2 days, they would have paid maybe $1 for it. Well, let's say they paid $1 for it or $2. They would have made $70 or $80 on that $1 or $2 payment in. Now, you might think, dude, I could just put like $100,000 in this. But Google's not going to move 9% every day. It's just it moved because of the results. But you can target it saying, on those results days, Google is extremely volatile. So let me buy something that's deeply out of the money, where I pay only $1. And if it gets there, I make $60. If it doesn't get there, I lose $1. So it's an asymmetric bet, but very improbable.
I'm not sure how you're intending this to come across, but somehow it is like I can completely see the excitement, and it does seem, as I said, attractive. So let me move to my next question, and I'll sneak in one more, and you can see how you want to answer them. But as you were saying this, I'm like, okay, I get it. So why is this a problem? Is this a problem? Will the government or some authority like SEBI or come in and put an end to this, or stop this, or raise taxes or something? Or why are you so hesitant in your endorsement of these things that have been happening? Isn't this a mark of, can I call it, greater sophistication in the market? I mean, we keep saying liquidity is the best thing for markets to have. So isn't this adding to liquidity, and shouldn't we be cautiously celebrating the increase in options volumes?
So there are good reasons to celebrate some of this, but I can tell you this. It has become a casino. People don't anymore look at it as, oh, I'm buying an option that gives me the right but not the obligation, etc., etc. They're looking at it as, dude, I'll put 5 rupees, it'll become 50 rupees. Oh my God, I'm rich and I'm smart. That is the fundamental rule of even how casinos attract people, because casinos show you these dazzling lights, and when you see those dazzling lights and you see people win some money, the tinkle of money that follows a big win in a slot machine, that is what drives people to keep betting on machines like this. Now, a casino, the feeling that a casino draws is probably the same feeling that the unsophisticated option player is playing, which is the guy who has only 10,000 rupees who's coming in saying, I'm going to keep betting this 500 rupees until I hit one jackpot of, say, 50,000 rupees. And then I'll stop. And at 50,000 rupees, which he makes one day, he then says, I will keep betting. Now I'll bet 2,000 rupees until I make 5 lakh rupees. And chances are he goes back to 10,000. Then he starts again with so it's like one speculative ride over the other. So that is why I think we should be skeptical of it, because people who are playing this are playing it like they are playing a casino. And the difference between a casino and this is that there is no one winner. In the casino, the winner is almost always the house. The house has an edge over everything. So if you're playing the house, in the long term, you will lose. The math is designed so that you lose unless you're playing unfair. According to the laws of the casino, you cannot count cards. You cannot try to get yourself an advantage, because that hurts them. There's no such thing in options. You can play as much as you want, and the other side is just as smart or as unsophisticated as you are. You're just playing the other side, and chances are you win, chances are the other sides win. Now, what has happened so far is nobody has universally lost money. It's not the buyers of the options that have lost, it's not the sellers of the options that have lost. So since both sides have played roughly the same, you have a situation where the government is almost like saying, listen, if you're playing against each other and I'm making an STT in the middle that you guys pay me on every single thing that you do, and it's a regulated interface, you're only bringing in legal money, there's no cash wash and all that stuff, maybe it's fine. Now, will they come and stop it? I think yes, if there are huge losses made by any given player or a few players, because there's an extremely volatile day and everybody piled in on one direction, that might actually happen. But remember this, okay, if the last casino kind of that happened was NSCL in 2014, where you had a situation where it was something very similar. People were making free money or what they thought was free money for the longest time. And there was a contract there also. It was a futures contract, but the contract was that if you paid me 100 rupees today, I would pay you back 101 rupees in 15 days. Then I would take the 101 rupees from you and pay you 102 rupees after another 15 days. Now you're thinking 1% every 15 days is equal to 2% a month is equal to 24% a year. It's just, oh my God, I'm rich. Unfortunately, when the government extended the contracts and said you can't do just 15 days, you have to do a minimum of 28 days or something like that, the contracts entirely broke down and you found out that quickly that, listen, you weren't playing with each other. There was always one set of people on the sell side, and all the buyers there were 5,000 buyers and 6 sellers of the contracts. So they were the ones who were making it a Ponzi scheme and rotating. Now you've got a situation where you used to have monthly options, and suddenly now you have weekly. Every day there's an option expiry. On Thursdays is Nifty expiry, so the Nifty contract expires. On Wednesday it's the Bank Nifty expiry on the NSE. On Friday it's the Sensex options expiry at the BSE. On Monday it is the BankX options at the NSE. And I think there's something called a Fin Nifty, which is on Tuesdays. So essentially you can come in every day and say, hey, which 0 DTE option should I buy today? And boom, you have something to play with. So what was really a monthly idea of options has now become a daily idea of options. So that is where I think the speculative thing has come overboard, and this is allowed as a way, and I think it's just gambling. I honestly think it's just pure gambling. We haven't yet seen people. Okay, let me ask you this: what can kill? I think that's the question you might have in mind.
Like what when you said it's picking pennies in front of the steamroller or one day you die. So how badly do you die in this?
Okay, let me. I mean, we've talked about. I don't know if we have talked about this before, but there's something called a Walmageddon in the US. In the US, ETFs are allowed to buy options. So there was an option that bet on the price of something. I forget what that something was. Oh, sorry, it bet on the volatility index itself. So the idea was that you would buy these options on the volatility index if the volatility went up like crazy. And the idea was to go short volatility, assuming that, because markets always are like this, okay? So you think that the market, Google would have moved 9%. Now it's possible that some player would have thought that buying option would have been profitable. But it's possible that the seller said, listen, Google always moves 10% or 9% every time. So I'm going to charge you so much premium that you will not make money even if it moves 10%. So if you pay such a high premium for the volatility, then your volatility, you've actually paid more for the volatility than the actual volatility, which means your implied volatility was higher than the realized volatility, IV greater than RV. So if IV greater than RV is a thing, then I should keep selling volatility until, and over the long term I'll make money. Except in this particular case, the IV was really low, and suddenly the RV, the realized volatility, just shot through the roof because of 1 or 2 big days in the S&P 500, and that basically killed people who had bet on this ETF, which went to zero. It didn't just go to like this thing, so it just went to zero. So you lost 100% of your money if you had invested in this ETF, which is one thing that happened, and that should have killed a lot of option players. But guess what? It didn't. In the US, 0 DT options continue to be very popular. In India, we haven't had such a situation yet. So still, I would say if it kills a few people, if it happens, it's still better than a casino because the odds can be in your favor. You can actually build a strategy to trade options where the odds are in your favor. You can't do that with a casino.
Okay, I think I'm sort of getting where you're going with this. Right now, there have been no casualties of significance in India, but the more you make this popular and the more people get attracted by the payoffs, you could get some people in who aren't as well off or don't really understand what they're doing, and it could end very badly for them, at which point they will be justifiably be like, why did you let this happen, to some extent. Okay, I understand that argument. I'd like to zero in on, interesting choice of words. I'd like to narrow in on the 0-day expiry option. And I think, in your opinion, this is the epitome of the gambling part on options, right? I mean, when you have a ZD, your point is that this is completely takes away any investing frameworks whatsoever from this conversation. And now it's essentially just gambling. And I wanted to ask, isn't it still a positive economic activity, or isn't this, as you said, since there's been no mass casualties, is it really such a big deal? I guess I'm just asking the same question again. But do you have personal stories or experiences with people who've lost money on this, and how does this end badly, or how do things like this end badly? Maybe.
So I'll give you, this is actually a great question, because this is exactly how people should be, in 2011, and this is long back, people were still writing options, and they were telling people at that time, listen, in India, people are paying too much for options. So let me sell options every month and I'll make 2% per month. Now, a certain person I know, I remember had told me about something like this, where he said, 2% per month is great. I want to take this product, but Deepak, can you just look at the product and tell me what this is like? I said, look, they're writing options. So the only problem will be like this. Life will change. Today you're getting 2% per month. Tomorrow, you will not get it because hundreds of other people have gotten into the act. So that 2% per month will become 1% per month. Because he's promised you 2% per month, in order to get to that 2% per month, instead of writing it at considerable distance, at that time you could write the Nifty option 10% away on both sides. That means the Nifty had to move 10% for you to lose money and still make 2% a month. That means the premiums were high enough that would give you 2% per month, 1% on each side, that is, if you wrote options 10% away from the Nifty. So essentially, unless the Nifty fell 10% in a month, you were fine, which was rare relatively, and then you would not lose money. This according to me was okay. The problem really was when the prices halved, when other people got involved, because when you have more people selling, the price will come down. When the prices came down, what was being offered was, at the same 10% distance, you had a 0.5% return on each side, which means 1% in all. Now they promise you 2% a month. How do you get 2% a month? Instead of going 10% away, you go only 5% away. And you say, you know what? The Nifty doesn't fall 10% in a month, but maybe it doesn't fall 5% in a month. Let me write the 5% options and make my 2% a month. That 5% becomes 3%, 2%. And when it narrows to a considerably tiny number, 1 month, the Nifty moves either up or down or both. In fact, in particular case, both happened. And this particular person ended up losing nearly 60% of the returns he had made so far.
But he didn't lose capital,
No,
right?
he lost plus the capital. So, idea being, if he had given 1 crore, it had become 1 point or 2 point something crores by in 2 years or something like that. And then it fell down to 80 lakhs. So, sorry, it was 1.5 crores, it had become 2 crores, it fell down. So he had lost 60% of his original capital. This changed the game for him, because he was like, I thought they were doing 2% a month and no risk. I said, who does 2%? No, but that's not the point. The point is not 2% a month at no risk. The point is, you could predict the behavior of the person doing this trade, because the first 3 months, the guy thinks he's invincible. Apunich Bhagwan hai, I have done these trades, I am the winner. Volatility narrows. He says, dude, if the Nifty won't move 10% a month, it won't even move 5% a month. Let me go down. I'll get the return. I'm still the king. It goes down to 3%, 2%. He's thinking, the Nifty is stable. 2% is a lot of money. It's not going to move 2% a month. And one fine day, Nifty moves 2% in one day. And that kills your option. In order to make up for it, what he does is, let me double down. Let me take more contracts, because you know what? This is an arbitrary move. The Nifty should go back into its earlier range. So I'm going to write those options again. He writes those options again. Nifty continues to move in another direction. You are hosed, and he lost significant amounts of money. Another example, a friend recently called me. He's works in a PSU company, and he has spent his entire savings, life savings over 40 lakh rupees in buying options and losing money. Because he saw some course online which he saw, I said, you can make money buying options because it is low risk. Buying options is not low risk. If you lose money, you lose 100% of your capital. It is extremely high risk. So if you find such a strategy where you think it's low risk because you're losing only 2 or 3,000 rupees at a time, you can quickly lose 40 lakhs. Because all he did was buy a little option here, a little option there, made some money once in 10 trades, felt excited about it, and then lost most of his money. He thought it was legit, it was a way for him to learn. Unfortunately, he just lost all his money. And you know what? He's taken loans now to be able to pay back whatever other things that he had done. But and he doesn't want to tell his family that he has done this because it's a social. How can you tell somebody at the age of 45 plus that you've lost all your life savings by gambling it away in the stock market, by buying options, and the market has actually gone up in the last 8 months or something like that, right? So it's almost sounds like it's unbelievable.
Okay, well, I have a bit of a pushback on this. I kind of don't know where I stand, so I might be all over the place, but here's my pushback. I remember reading from something, I think of all things, Sandeep Parekh, the lawyer, had tweeted somewhere that, look, and if I'm misattributing, my apologies, but he'd said that, look, the goal of SEBI needs to be to remove ignorance from markets, not to remove stupidity, something to that extent. Can't say I feel too much sympathy here, and I'll tell you why. Because SEBI is quite clear that, dude, if you're dealing with someone who is not a regulated, I guess, RA or RIA or one of these things, then A, you shouldn't in the first place. B, you have a sense for how much money people can make. I mean, you can make, say, 20, whatever it is. So if someone is offering you something more than that, you have to kind of wonder why they're coming to you and why are you so special and why are they so special. So, if I may say, there are crimes or failings where you feel a lot of sympathy for victims. Like, as you know, I knew a household staff person who fell victims to one of these bad loan apps, the endless Chinese loan apps as they were called, and each one was connected to the other, and a 30k debt quickly ballooned to 2 lakhs, which became a disaster. So I do completely understand that. But on the other hand, this one feels, at some point, how can you protect everyone? Surely at some point you need to let people go out and take a risk and then learn from that. I mean, what's your response to that?
That's actually a good point. I mean, because that is the buyer beware concept, right? So it's like, simply said, people believe or trust other players that seem to be financially more savvy. They trust their bankers. They buy ULIPs because of the bankers, sometimes lose money. Here you trust
random person on Twitter.
On Twitter, on YouTube, on Instagram, who says they've made money doing this. They even show you how they made money. It may be selective, but yesterday there was an order by SEBI against somebody else called Bapov chart. Now, forget the order, but the guy goes around saying that I have made so much money using my options trading that all this money I charge for these courses is irrelevant. Turns out he's made 17 crores selling courses and lost 2 crores 85 lakhs in the market. That means he's technically, he shows you the profitable trades, but he's actually got a lot of loss-making trades he doesn't show you. So when he shows you the profitable trades, you look at him and say, oh God, he's Bapov chart, therefore he's good. But here is where your problem comes, is where you're believing what you're seeing and you're not asking the right kind of questions.
Well, here I'm actually sympathetic, because where is the forum to ask the questions? I mean, there is no forum.
There is no forum. And in fact, even if a person comes and tells you this person is wrong, you're looking at him and saying, look, dude, it's either him or you, and I don't know either of you. And SEBI is warning me, but SEBI's job is to warn me. My parents told me don't eat ice cream. I ate ice cream and I loved it. That's the problem, right? We come up with that.
So you think SEBI is too conservative, is the average person's view, perhaps?
Yes, they're like, the SEBI doesn't want me to make money because I'm too small. They only want the big guys with suits to make
something
money.
like that.
That's the thought process that people come up, right? Let's say you've reached a situation where something like this happens. Now, SEBI has very strict rules against people, and especially if SEBI is going to side with the little guy and say, listen, I don't care who you are, but if you made someone lose money, then it's your fault. So if there's a complaint, I'm going to go after you. So if you're a regulated entity and you've done this, and we've seen this many, many times in the past, where people go to the SEBI and complain against a broker that he made me lose my money and all that stuff. And SEBI generally says, listen, dude, this guy didn't know head or tail of this. I don't know what you sold him, but whatever it is, it's your problem, and you've got to solve it. So many times the settlements, they say, I've lost 10 lakhs, then the broker says, I'll give you back 5 lakhs. Fine, just keep me off the regulator's hair. And that's something that happens. But I think by and large, you are right. We should be not ignorant. We can't hide behind this, oh, you know what, I went there and I was such a rich HNI and I went to NSCL because I'm getting nearly 2% a month. How why can't I earn at least that much? I deserve so much more on my capital than everybody else. And then when I lose money, I go back to the regulator and say, how could I have known better because somebody told me this? I think that's the wrong attitude. You should be able to ask those questions. And when I saw NSCL at the first time, I was like, I don't know what it is inside it, but something about it does not look right. How can you consistently make money in the market in that strategy?
Unless you're Renaissance Tech or whatever.
I mean, yeah. And Renaissance Tech is usually not the kind of guy who's telling you, come, I will tell you my strategy. This is order I place for buy at 40 rupees and this is the way I buy the sell. Renaissance Tech is more like, dude, I don't have any space in my fund. I won't tell you what I'm going to do. I'm going to do something. If you don't believe me, don't. I have no problem with that. I will file my taxes and somebody's going to leak it out to you and tell you that I've earned so much money. I don't care, because that's the kind of attitude the guys who actually make money are, right? But at some level, if you're a licensed entity to manage other people's money, you have to reveal globally how much money you make and so on. So here is where I think one of the big problems over here is simple. It's not only the buyer that doesn't know what they're doing. Sometimes it is the person who's managing this money who does not know head or tail of what they're doing. I'll give you an example. And this is really unfortunate. This is a person, IIT credentials, YEVO and all that stuff, who goes in and says, I've built this algorithm and I have backtested it across various parts of the market. So I actually met him because a friend wanted to use his services. I said, what's the deal? He said, no, you know what? We have these complicated system. I won't tell you what it is, but it's a complicated system. It generates these buy and sell trades. I said, dude, we have not seen a volatile time for a while. And how do you handle volatile times? And interestingly, what he told me was, listen, we will close the trading if we lost 20%. So we have an automatic stop loss when we close the extra thing when we lost 20%. And he said, but you know what? We've never seen a 20%. I don't think it's ever going to happen. This was 2 months before COVID. In 6 months, he had ended up losing 45% of the guy's money. And when this person told me he's lost 45%, I have a problem. I went back to him and I said, what happened here? And then we decoded the trades. And the same thing. The problem is the experience is exactly the same. The guy loses 20%, he's supposed to stop. He doesn't. And when I asked him why he didn't stop, he said, I thought I'll recover it. And because you don't have the experience, you don't know where to stop. And suddenly you have lost way more than you thought. A lot of people simply don't know that what do you do in the face of extreme volatility is you have to cut your losses, reduce your position size, and reduce your trading, not increase them. So people overtrade and lose those significantly larger numbers. And that's again the problem. So it's not just the buyer that doesn't know what they're doing. The seller doesn't know what they're doing and doesn't even know that they don't know what they're doing.
I think that is actually something worth pointing out, that the person selling this may not be aware of edge cases or when things can go wrong. One short question and then I'll move to the next part of this. I think in a past podcast, you've talked about how SEBI has been systematically removing leverage from the markets in a good way. Just as you were detailing all of this, we're sort of inadvertently through, I guess, exchanges offering these products, reintroducing leverage in a way that runs counter to that. Is that fair to say?
I mean, it does run counter to that in the sense of that what has happened right now is instead of reducing leverage at the overall level, what is done is allowed people to lever themselves on an intraday basis. In the sense that you had a lot of trading on 0 DTE options. So you essentially have larger leverage, but it only lasts the whole day. So you don't have open positions at the end of the day, but you still have a lot of positions. So I think if you have a margin call situation, it can have a dramatic cascading effect even now in the markets. But you're right in that, you have a complex situation right now with respect to margins. What has happened now is margins have also come down. So if you wrote an option, there was something called a short option minimum charge, SOMC. This short option minimum charge was a certain number, and you said if you had to pay 20,000 or 30,000 rupees per contract, no matter which contract you wrote. Today, because of volatility considerations, those short option minimum charges have come down to 10,000 and 8,000 rupees. So your leverage is actually increased because volatility has decreased. And you know what the problem with volatility is? It is not designed. Markets are not designed to be non-volatile. We've reached a position where markets assume volatility is of the order of 9% per year, which is insane because the average volatility even in the past has been 15 to 18 to 22%, and market expectations used to be as much as 30% volatility per year. So given that, we have margin issues that can complicate matters very quickly.
Fair. Now, let's say I'd like to move on to the next section. People have heard you through this whole point and they get it. They understand the social dynamic, but they say, look, I am willing to invest time, energy, money, and build skills and trade these well. So can you advise me? I want to get into in trading through options. What are some things I need to look out for to make sure that when I get into this, I won't lose money or I won't be taken for a ride?
Perfect. This is great because when you start looking at options like this, and we've done a lot of work on options at Capital Mind in the past, before, not as a PMS, because as a PMS you have limited options. Oh, nice, very interesting. So, but you also have the ability to trade by yourself. If you're trading by yourself, one of the things that happens is, like I talked about time value, there's something called intrinsic value. I told you that buying an option at 20,000 strike price when the Nifty is at 19,800 is something called out of the money. What if I told you you bought a 19,000 rupees strike price when the Nifty was 19,800? The minimum price you'd expect to pay for it was 800 rupees. That's the intrinsic value. On top of that, you'll pay for the time value. So you might pay 840 rupees for it. Right? So this is essentially called the intrinsic value. And now the problem with this is like this. If you come closer and closer to expiry, the intrinsic value becomes negative. So that means the option which is 12,000, then 19,800 can trade at 19,000 at 700 rupees. And Nifty is 19,800, strike price is 19,000. It should trade at 800 plus. It trades at 780. Now you're thinking, this is an easy win, man. I'll buy it at 780. In a day, I'll make 800 bucks. That's like 3%. It's fantastic. Except what they haven't told you yet is, the first time you learn this very quickly is that if you let an option expire in India, the STT increases from 0.01% or whatever it is to 0.125% of not the premium, but the notional value of the contract. So you will pay 0.125% of 10 lakhs, which is roughly, 1,500 rupees. That is 30 rupees per Nifty. So what was trading at 780, you will end up getting 700 and, you'll end up having to pay another 10 rupees for it or something like that, 30. So you'll end up losing money even when you thought the intrinsic value was positive. So this happens at close to the money option. So if you buy something at 19,700 call and 1 hour before expiry, you think this is called a negative premium disaster. So you think of a negative premium, but it's not negative premium. It is actually inbuilt STT problem inside it. In stock options, you have something that's settled by delivery. Now, earlier, I'll give you the history of stock options quickly. Stock options should be settled by in something called American options, CA, and PA. That means in American options, every single day somebody can exercise the option, not wait till maturity date. In every single day, if you can exercise it, what would happen is people would manipulate options. At 5:30, you would get the notification that your option has been exercised, and you have to pay the difference between the current price of the option. And so if you bought an option, for instance, you could exercise it. So if you sold an option, you would get an exercise against you, and that exercise against you would basically take away all your profits. And the next day, the stock would open in a completely different direction. So your hedges, which can only be traded in the day, are gone. So they moved away from American options to European options. European options can only be traded on the exercised on the expiry day, and they're automatically exercised. So now what they did was, earlier they used to exercise everything by cash, saying if you bought at I don't know, bought an option for 100 rupees whose whose strike price was 500. So that means you would get profitable above 600 and the stock price went to 620. You would just get the 20 rupee, or you'd get 120, which is the strike price minus thing, and you would have paid 100, so you made a 20 rupee profit. Now what they do is they say, no, don't do that. Let's do something called settle by delivery. So if I buy a Reliance stock, Reliance is 2,300 rupees per share. If I buy a Reliance option at 2,300 strike price and I pay 20 rupees for that option, my 20 rupees is gone. But if Reliance on expiry date settles at above 2,300, I am required to put the full 2,300 rupees down so that I can receive the share of Reliance in my... so actually it's settled by the delivery of the share itself. The problem with this is I paid 20 rupees. Now I'm supposed to shell out 2,300 rupees on expiry day. Suddenly what was perfectly fine as a small guy who's paying 20,000 rupees has to put 5 lakhs, 10 lakh rupees just to get that Reliance share in his demat.
But only for like a day or something,
Yes.
or a few hours or something?
But
But you don't have it.
2-3 days.
Oh.
Because let's say the Thursday that the stock options expire, and then in 2 days you will receive the share, which is Monday, and then Monday you sell it, you'll get the money on Wednesday. So it's actually a 6-day cycle in which this finance has to happen, right? So somebody has to give you 2 lakh rupees for 5 lakh rupees for that much time, which is a problem. So I think that is the second part. So many brokers just simply say, listen, stock options not available to you 2 days before expiry. So you want to build this great strategy. You have this back test that says, I can write options and the stock options the last day, do it 2 days. But brokers don't allow stock options. But the zero DTE options are all index options, not stock options. Stock options still mature only once a month. And they're considerably less popular compared to index options. Now, the other thing that people will tell you is that you can make free money by selling a call and selling a put option on something called theta decay. That means this time value, like I talked about, the time comes down, people pay, let us say people are paying 1 rupee per second. The number of seconds goes down, the price of the option will keep falling. So naturally the price of the option will fall compared to as time goes by. So this is called a theta decay. The theta decay effectively means that if you sell first, the price falls down and then you buy, you make the difference between the two. So you can earn profit from theta decay by selling options 1 or 2 days before expiry and then letting it come close to expiry. This is great because you're thinking, listen, the Nifty won't fall 10%. I'll write 10% around and all that stuff. But here's where things became complicated. People saw this and said, okay, I can do this every day. And they said, what about if the Nifty moves a lot? I write 1% on each side. That means Nifty is 1% down, I'll write a put option. Nifty 1% up, I'll write a call option. Nifty doesn't usually move 1% in a day. But if it does, guess what I'm going to do? I'm going to do a stop loss order. They do a stop loss order. They used to place something called a stop loss market. Now, stop loss market is a complex order which says, if my stop loss is hit, please trigger a market order selling whatever I own or buying whatever I own. In this case, since I have sold first, I need to buy whatever I own, whatever I have sold at the market price. So if the price hits 35 rupees, please put a market order. Now you're thinking, I have sold at 10 rupees, I'm going to buy back at 35. That's the idea. The idea is to set up a stop loss at the upper level. I've sold at 10, I'm buying back at 35. I place an SLM, stock loss market order, at 35. What happens then is that hundreds of people like me, because they're following the same YouTube fellow and the same guy with a suit or whatever it is, and they're saying, listen, we'll all place orders at 35. When the price hits 35, all these market orders come into the market exactly at the same time. When they come exactly at the same time, they wipe away the order book. There may not be many people selling at 35. But the orders to sell may be at 45 and 50 and 70. So some people, they put their market order at a trigger of 35, but they see their order executed at 70. And then they go complaining, I got manipulated. It's not manipulated. It's just that the market is shallow. Options markets are shallow because every stock has maybe 20 different strike prices. There's a call option and a put option. So, and each expiry date is different. So you don't expect that there'll be liquidity at every price. So now, what is the solution? NSE said no stop loss market orders. Now soon BSE has also said no stop loss market orders. You have to create something called stop loss limit orders. That means you can only say, if the price hits 35, place my order to buy at 37. It's obvious because now what happens is if this order book still gets wiped out, your 37 may never get executed. It may go to 70 and stay there, and you're sitting there saying, dude, my option, it's gone to 70 rupees, I'm still losing money. How come? So that is so you will, if you're doing these option strategies, you should be aware that if there are lots of people following this stop loss funda, you should be extremely careful of where you place your stop losses, whether you place them at all, or whether you should build yourself an algorithm or have a person sit and monitor the trade at every single point in time, so that if it hits 35, he manually places an order for whatever the price is at that time. So that may be a better way for you to, look at. I think here is also where I would say the pennies and steamroller wala part comes in. You will write options for 10 rupees each time, and then you will see one big hit which takes away 100 rupees. So if I told you this was the sequence, the question you would say is, Deepak, that means if I make 10 tries and I lose once in 10, it is 0 for me. So I would say yes, because you need to have a strategy that makes a loss only once in 20 times. Otherwise, you shouldn't take this trade, right? So that's another way to look at it. Now, the other way to look on the other side is if you're buying an option. If I'm buying an option, I told you that 99% of the time people lose money in options when they buy options. So when they buy options, what happens is they pay 10 rupees. They lose all the 10 rupees because the market takes it to 0. And they lose so often in these options and so quickly that people don't realize how big this is as a deal. Because if I have 25,000 rupees and I put 25,000 rupees into 10 stocks, 2,500 rupees per stock, chances are the stock will fall 50% at most. So I still have 50% of my money. And even if it falls 50%, it won't fall in a day. It'll take a few days. So I actually have time to get out. Maybe I don't lose all 50%. I lose only 20%, and then I am able to get out. You can still keep most of your money, right? It's not so in options. In options, if you print 2,000 rupees on options, within 10 seconds, it can be 100 rupees. That means you've lost most of your money without even being able to do anything about it. And because of that, if you have only 25,000 rupees, you probably should spend only 500 rupees on an option, not 25, not even 2,000, not even 3,000. So people, what they do is they take 25,000 and put all of it on an option and then count their returns from there. That is the bigger problem.
Okay. So I'd like to ask then a different question. Now, let's go on to the positive. Let's say I come to you and saying, Deepak, I get it. But surely options have some positive uses. You're basically just calling them gambling, but surely they have positive uses. So could you tell me a bit about that? And second, let's say I want to... I will practice great risk management. I want to build a sophisticated trading system because we've discussed Nifty will give me some 12%, it seems, and no one seems to be pushing back on this number over a 10-year period as total returns. So if I buy index fund, that's the best I can hope for. But here you're saying it's somewhat possible I could even aim for 2% a month. I won't give this money to anyone else, some unregistered advisor who I met on Twitter. I will build my own systems and run it myself. How can I try to do that, or what advice do you have for me if I want to do something?
This is great. Actually, so take the negatives out. Now, why did options, become popular in the first place? Now, there was a mathematician called Ed Thorpe. He was a mathematician at MIT. This guy he got himself banned from hundreds of casinos because he went and measured things like he started card counting at blackjack, and he wrote a book called Beat the Market, after which they changed the way blackjack was handled at casinos. Now, he came to the stock market and figured out that, dude, there's something like this in the stock market called convertibles. Convertibles are, if I buy a share of X, then at any point in time, I could pay, I can pay a little more money and convert it into a share. It's called convertible preference share. And in India, it's called convertible preference shares. So what happens really is that, or in India, you have something called convertible preferential warrants as well. These trade in the market. They trade right now. For instance, Airtel has something called a rights issue wala share or something like that, where if Airtel wants, they can ask you to pay another 400 rupees and you get a share of Airtel. You've already paid for it. It trades in the market at 450 rupees or 550 rupees. Airtel's price today is 901. So you're thinking, if it trades at 450, I have to pay another 400. Together the price is 950. but I pay only 450 right now. The reason you're paying that 50 rupees extra compared to Airtel stock price is because you're paying less. You're not paying the full 900 bucks, you're paying only 450 bucks. So this sounds great, or 550 bucks. 550 bucks, yeah, 550 bucks. So this is like a preferential. It's like an option. The option strike price is 400. You're supposed to bring in that 400 only at the time when Airtel decides. And Airtel it's been on for the last 2.5 years or 2 years. So you can decide, Airtel can decide maybe in the next another 2 years, sometime it will exercise these rights issues and then you have to pay the rest. That's also an option. It's a convertible, right? So now you didn't know how to price this convertible. This is in 1960s. So people were pricing them at anything. They didn't know, okay, let's price it at 100 rupees, $100. Ed Thorpe figured out that there's a model. He designed a model because he was a mathematician now. Mathematicians apparently are now the new sexy thing. So they design models and therefore he came out with a model of how to price these convertibles. More famous in this strategy was 3 people, Black, Scholes and Merton, who won a Nobel Prize for economics or something on the basis of their ability to write a formula that figured this out. Now, the guy who actually earlier figured it out was Ed Thorpe, but he did it for himself. He did it to earn money. And he earned a lot of money writing these options because he said people are overpaying for these options. It's not as bad as it is. And when he wrote those options, he made a truckload, killing in that market. He actually wrote a book called Beat the Market. First he wrote Beat the Dealer, which was for casinos. Then he wrote a book called Beat the Market, where he actually said, this is exactly what I do and this is how it all works. And, he talked about it. So doing that is perfectly fine. You're actually going in and saying, I understand the theory of it and I've mapped it out and I can figure out the risk. Now what does that mean? That means you can price optionality. Now pricing optionality is very interesting because there is a genuine return in the long term to understanding the optionality of anything. I'm giving an example. There's a stock. It's at 40 rupees per share and its market cap is 500 crores. But it is building a patent. And that patent, if it gets a patent for whatever it is doing, the value of that patent because some pharma company is going to buy it or something like that is like worth 8,000 crores. So you have a chance of that patent making it or the chance of the patent not making it. Let us say you assign only a 2% chance of that patent making it because it's too early in the process or something like that. How do you price this company whose market cap is 500 crores against the fact that there is only a 2% possibility that one patent can make it worth 8,000 crores? The answer to that has to be in optionality. So you try to figure out what that options price is. And over time, it will build. That 2% will become 5%, in which case the value from 500 crores will become 900 crores. That's now the value of the company. If it's trading at 400 crores, you say, well, the 400 can become the 500 that I think it's worth. If it becomes 900, then the 400 can become the 900 I think it's worth. So you can actually price companies based on the optionality of things that have intrinsic optionality. Patents, say a contract. There is a potential chance of it winning a particular contract that gives it 5 years of cash flow. But you don't think that probability is 100%. You think that probability is like 25% because it's competing with, I don't know, some Adani company, some Ambani company, something like that. So it's a very small chance you get in. How do you price in that probability into the price of the stock? You can't unless you use some kind of option pricing framework. And if you understand that pricing, you can actually price companies better. So if even if you're doing fundamental analysis, wherever there's optionality built in, that optionality can give you an understanding of what it means. To give you one solid way to kind of look at this, it's infrastructure companies that are using toll. So there's a toll company that gets a percentage of the toll charge for a highway. That percentage of toll will vary based on the traffic. Now you can model the traffic, you can figure out how much the traffic will move. So you can say, listen, if the model allows me to scale based on traffic, I have a certain thing. There'll be some edge cases. What happens if, for instance, traffic really booms or really goes down? And you want to price in those extreme scenarios, you'll price them using options as well. So that is one part. Now the sophisticated thing that you talked about. Like for instance, I said, we've done this before. We've said the IV greater than RV. IV is always usually greater than the realized volatility. So there are times when the IV implied volatility is an extreme. People before results expect that results will move a stock quite a bit. So the implied volatility in terms of the option prices increases quite dramatically. So we have seen this in companies like TCS, for instance. In TCS, before the results, and TCS is one of the first to announce results usually, the implied volatility of TCS options increases dramatically just before results. So if you expect a certain move in TCS after results, that expectation usually on normal days would be, oh, well, it's going to move in a month, maybe 3%. On result months, the expectation moves to 8%. That means you will not, as an option buyer, make money if TCS moves less than 8%. Now, if you're a blind buyer, you would have gone and bought this option saying TCS to move karega option mein guaranteed it's going to move. And then the big thing happens, the result comes in, the stock moves 6%. The problem is you paid so much premium, that premium collapses the next day. It's called an IV collapse post-event. So your IV collapse ensures that 8% that you paid as a premium has actually made you 0 rupees. In fact, probably lost you rupees, because now the option trades at a much lower value, even though TCS has moved 6% on that day. It's just that the implied volatility was greater than the realized volatility. Now, the way you can tap this is you can map implied volatility of every single stock and every single option and find out stocks which are trading at the extremes of the IV range. That extreme of the IV range may be 28% where the normal is 18. And you say, well, you know what? 28% sounds extreme. Let me take a bet that it will not be 28%. And in the next few days, that 28% will fall to 24 or 23%. That fall itself makes you enough return on capital, and you can model this. The modeling might show you that return on capital which you do might be as much as for every 1,000 rupees I put in, I'll earn 300 rupees per year or 25 rupees per month on such a calculated risk. That is a good way to do it, because, and plus you can have your stop losses in place by setting up hedges and all that stuff. I think that by and large has made people money. It can be opportunistic as well. You're not doing it all the time. You're just doing it when there is an event of an extreme. The last bit is simple. This gamma, delta hedging and all that we talk about is simply a market. In a way, it could be a market making exercise as well. So you find that in many stocks, FIIs come in first. And nowadays, when FIIs come in, they don't want to buy a stock directly. They buy the future first or the options first. When they buy the futures and options first, the prices diverge from the underlying stock. You can build an algorithm that arbitrages between the underlying stock and the future and option. It's called market making. And in the end, get yourself a profit, because what the FI wants to do is buy the stock. He's bought the future instead. He's eventually going to get the stock. So the prices will converge. And when the prices converge, you make the difference. And the difference was high only because they bought the FIs first. And many FIs and PMSs also, by the way, hedge their stock. So you can build an algorithm that profits from such hedging, in the sense of when a PMS needs to hedge, they might say, sell me a future. And if you're going to sell them a future, they want to buy a future, sell a future to protect themselves, that means you're going to be the buyer. If you're going to be a buyer, then you need to hedge your position some way. You can use options to build a hedging position against your companies. And if you look at the profits of some of these high frequency trading companies that just make money on these temporary intraday mispricing frameworks, I'm talking 500, 600, 700 crores of profit per year.
In India.
Per company in India. Yeah. And in the US, Rentec is an example of billions and billions of dollars. So
fair. So would you agree with this characterization that if you really like math and not so much fundamental analysis, then options is probably something that works for you?
Geek out time. It's just total geek out time for you.
And therefore that's the way you make money in this. If you're the type of person who likes math and likes doing this analysis, then there is good money to be made here. But if you're not, then it'll be like that thing where you go into a poker game and are still wondering who's the patsy.
Yeah, I think that's the point. In fact, if you look in a poker, like you've always said, if you look at a poker game and see nobody else looks like a sucker, then you're the sucker. In the end, if you're in an options game and your skill is identifying from the promoter's body language whether he's telling the truth or not, you will not make money in options. in all probability. Of course, once in a while you might end up.
You may make money on stocks is where you're going.
Yes, you may make money on stocks. It's a great advantage to be able to know when the promoter is telling you something that you can identify from his body language. But the interesting part about options is it's a mathematical play, it's a systematic play, it's a way to engage with the market to reduce risk, not increase it. The problem is we use it to increase risk, and that screws everything up.
My ending question then, where do you see things going from here? I mean, given that zero-day options are there, they've become so large, do you see some big person stepping in to clamp down on stuff? Do you see, or do you just see this growing unabated? What's your view?
Okay, just to put a clarification here, we own some players in the stock market in terms of their stock. So we obviously benefit in some meaningful way from the plethora of options that are being traded and all that stuff. But here is where I think we go. I don't think we are going to hurt right now in the near future because everything is above board. People who are making money are making money. People who are losing money. There are no dramatic stories of people jumping out of windows and committing suicide and all that stuff. At some point, like in all systems where there's a layer of gambling that is involved, the government comes in and claws out profits. They will send you GST notices, they will increase the SGT, they will do some drama to kind of ensure that, listen, if you guys are going to make so much money and lose so much money in a day, why don't I tax you? And I'll tax you at a higher rate for such profits because somehow they are not earned meaningfully. This will come at some point. Also, because what's happening now is there's lots of bots that are platforms that are building bots. They are saying, listen, if I can codify the rules, it's all math anyway. Why not automatically trade? So people are now. If you build a bot for yourself, fantastic. But now people are building bots and selling it to other people. It's like, dude, if I have a money-making machine, why am I selling it to other people? But no, they will sell it to other people. And then those other people don't know how to use these machines. It's like, giving me a rocket. I don't know what to do with it. So given that people don't know what to do with it, they will end up either overtrading, not configuring it properly, or the bots themselves are so unsophisticated when they're sold to other people, they're not taking care of extreme edge cases. Bots behave badly. They will actually be responsible at some level for bringing the market down. Now, I don't say this was actually the case, but in 1987, when the market fell 22% in one day, one of the reasons was program selling. There was a program that was built to say, if the market fell by 10%, sell. So the market fell by 10%, somebody sold, and somebody else had configured the market fell 11%, sell. So if all these people sold at the same time, that minus 10% in any day became minus 28% or 22% or something like that, which was a single day in 1987 on October 1987, exactly 36 years from today, 36 years ago is when this big day happened where the market got destroyed. Now, the problem with that was bots behaving badly, and I think the problems in India's option trades will also be bots behaving badly if it happens, because there are too many of them now. There's also the other good thing. I mean, I'm saying this is the bad thing, but bots can actually also reduce your need to be in front of a computer all the time. So you should use them meaningfully if they're built right. Preferably build them yourself or know what they're built of so that they don't act in an extreme way. I don't think bots should be banned, to be honest. I think all trading is eventually going to go electronic anyway. But I just think people need to focus on risk management more. Now, I think because of this, people will find their ways into regular stocks, because over time you'll find a lot of these Walmageddon kind of days happen in India as well. And that is going to bring people back into regular stocks, because they'll be like, dude, I don't want to make 40% a day. I want to make 1% a month is also fine. It's the longer term. Lastly, remember this, I remember I told you about implied volatility. The implied volatility is captured by something called the VIX. This VIX is usually 20 plus. In the last few years, it's been 18, 17, 16, 15 and all that stuff. So because volatility has come down, today it's in single digits. This is scary as hell, because things are going to change very rapidly in the world, and I think in India as well. We have not seen volatility. That means we're going to get too much of it. I think we're underestimating volatility, and I think we're underestimating what can kill an option trader. And unfortunately, people don't know that they don't know, even today.
All right. So, ending with caution as well. There is serious money to be made here, but you should be the right person to do it and know your strengths. Thanks, Deepak. Thanks for listening. If you have ideas for future podcast episodes, do send them in to podcast@capitalmind.in. If you're interested in investing with us, then visit capitalmindwealth.com to learn more about our portfolio management service.